Alrighty, folks, we are so lucky to have Mr. Dan Bird here to talk about stocks, talk about investing charts. He's been doing this for a couple of years now. We're actually doing this inside the One Rental at a Time school community. So we're actually going to take some questions from the audience. But Dan, you wanted to talk about a question you got last week about breadth. What is stock market breadth? Why don't we start there?
Yes, a subscriber asked that question, and I thought it was a great question. Let me just talk about it a little bit, and I don't think it's going to take too long to go through it.
Mhm.
So first off, I brought up Investopedia is a great site to learn to get definitions about things.
Mhm.
So they talk about breadth, market breadth, what it means. In general, it means if the market's going higher, there should be more advancers than there are decliners. That's one measure. That's probably the most prevalent measure. Another way that I look at it is how are all of the sectors performing? Are the sectors across the board all performing well, or is it just one sector that's doing well? So we'll take a look at that as well. So these are some of the breadth indicators. Advanced decline line shows you the advancers versus decliners, new highs versus new lows, S&P 200 200-day index. In other words, how many stocks are above their 200-day average or below that average, cumulative volume index, and on balance volume. Those are some of the breadth indicators. And I have a number of those on my site that we can take a look at. If we look at the advanced decline line, we'll do that one first. So right down here, there's some breadth indicators. Here's advanced decline lines. So you can see the advanced decline lines for the NASDAQ 100, the New York Stock Exchange, and the regular NASDAQ. They are all moving higher. So what you want to see with breadth is if the market's moving higher, you want more advancers than you have decliners. Mm-hmm. So you want the advanced decline line to be moving higher as well. Now, one question that a subscriber sent to me was, hey, I just read an article that said the NASDAQ advanced decline line is falling off a cliff, and that means we're headed towards a recession and the market's going to crash. So I did some research on it, and they were right. You can see it down here. Here's the NASDAQ, just the NASDAQ by itself. However, if you understand what's in the NASDAQ, it's a lot of upstarts in industries ranging from biotech to technology to alternative energy. Huge upside potential, but there's also risk for absolute failure. This means more NASDAQ stocks are prone to delisting. Companies that fall are removed from the index and replaced, but their negative effect on advanced decline line remains. So because the NASDAQ is made up of so many little companies that fail very often, that's why the advanced decline line appears to be going down much faster like that. So a better measure is the NASDAQ 100, which is made up of 100 of the large cap technology stocks, the ones that are not so prone to just going out of business. And if you look at that, the NASDAQ 100, it's a much different story than just the NASDAQ. So my message is be careful about how you look at these lines, understand what they mean first. And more importantly, be careful about the articles you read. Newspapers and on the internet. Don't just take it.
Doom sells, crash sells.
Right. Don't take it for face value. Do the research and understand what's really going on. So that's advanced decline. Another one is the bullish percent index. So the number of bullish traders versus bearish traders. So right now you can see the bottom, the S&P is generally going up. When it was just starting, it was very bullish. Then it became more bearish, but the market kept going up. And then in April, you can see how quickly the bullish index dropped. In April is when the market dropped as well. So that's another breadth indicator to see what everyone's doing. Also, the high-low chart. This is for the NASDAQ. It shows you highs minus new highs versus minus new lows. And we had been having more new highs than we had new lows, but just recently we're getting more new lows than new highs. And you can see it down here too. Here's NASDAQ and the NASDAQ 100. we still look pretty strong with a number of new highs versus new lows, but the number of new lows is starting to grow. So that might be an advance warning too, that we might be getting close to rolling over. Now that doesn't mean it's going to crash.
Right.
This means we might get a pullback like we did in April. And it doesn't say when that pullback is going to happen. You know, we could go, I personally think it's going to be probably mid-June, maybe that June 12th CPI number.
Yeah,
the
June
Fed
12th.
meeting.
Yep.
That might be the time when that happens. So we're what, 3 weeks away from that.
Mm-hmm.
So we'll see. We'll see what happens next week, because we've got two catalysts next week with
PCE and GDP.
yeah, both of those. And in fact, every week in my newsletter, I put in the there's so much in the newsletter this week. Not including the cartoons.
Yeah, you got to get the cartoons, man. Come on.
Yeah, I had Memorial Day. These were kind of more serious cartoons about Memorial Day, except for the last one, which is more stock market related.
Hmm.
The bull talking to the bear.
Hamburger.
Yeah. But every week I put in the economic calendar for last week. Mm-hmm. So you can see this is last week's FOMC meetings. And then next week, right here, GDP is forecasted to come in at 1.6. From 3.4 to 1.6. So that's it's still positive, but
that's a significant revision.
Pretty good drop. Yeah.
More than half.
Right. Remember, the official definition of a recession is 2 consecutive quarters of negative GDP. Mm-hmm. We're not there yet. We're not there yet on a number of different areas. And then PCE, I don't have a forecast yet for
0.3. 0.3 and 2.8. Yeah.
2.8 to 0.3. Oh, 0.3, 0.3.
Yeah.
And 2.8 again. So flat. So basically flat.
Flat.
So,
they're expecting flat. Yeah.
Yeah. So I think if both of those things happen, I don't think this GDP is going to make a huge difference for the market. I think the market actually would like to see the economy weaken a little bit. It's kind of bad news is good news.
I think that's where we are. Bad news is good news. Exactly.
Yeah, because it means the Fed is closer to dropping rates.
Correct.
So, but every week I put these, what happened last week and what's coming up next week.
Very, very cool. Well, let's get into some questions. We'll go to a stock real quick that I think reports next week. Costco. I think that's what COST is.
Costco, yes. Actually, I want to look at this one.
Charlie Munger's favorite stock. He always talked about Costco.
Charlie Munger's favorite stock. I actually had a subscriber ask me some questions about Costco.
Yeah.
And they said they bought it because it's Charlie Munger's favorite stock.
Yeah.
And he said, what do you think I should do? I said, well, I don't know. I can't tell you what to do. I'm not an advisor.
Yeah, exactly. I don't do that. Yeah.
But I can tell you what I'm seeing on the chart, and its
chart looks pretty good.
Breaking out of previous highs.
Mm-hmm.
So, I mean, it looks very healthy. I think it may have a pullback, but I would say looking at this chart over a 2-year period, look at that. It's just gone up.
It's a pretty big dividend. It has a dividend, I think.
It has a good dividend too.
Yeah.
By the way, Nvidia raised its dividend by 150% as well.
Yeah. From like 1 cent to 2 cents or something.
Yeah, right. Well, not when it drops to 100. Not when it splits.
That's true. Actually, that's true.
Dividend's going to look better.
Yep.
But anyway, it's extended pretty far above its moving averages. So, it would be healthy for it to pull back a little bit. I don't know if that's going to happen from the earnings report. I expect earnings are going to be good, but I think this run up before earnings probably is anticipating that.
Right.
So it could end up being a buy the rumor, sell the news kind of thing.
Yeah, but if you're a long-term holder, there's nothing in the chart.
If you're a long-term holder, then you should do nothing. And that's what this person said. He said, you have changed my thinking about the whole market. He said, normally I would say Costco is way up. I'm up huge. I mean, he bought it way back here. Said I'm up huge. I would be thinking about selling, taking my profits, and then trying to find another cheaper stock. But he said, after learning from you, now what I'm doing is I'm trying to figure out where to get in more.
There you go. There you go.
Where to buy
Well, the
more.
same student asked about NVO. I'm actually got to tell you, I'm not sure what company that is.
Novo Nordisk.
Oh, look at you, stock guy.
My brother used to work there.
Ah,
Novo Nordisk is kind of the same thing. Now, this is interesting because just from a technical standpoint, there's the highs right here.
mhm.
This is kind of what I do when I look at a stock. So it's right at the resistance. And Novo Nordisk doesn't report till August.
Mm.
So they've got a ways to go still. Let's see if I do this. If I draw a curve right there, for those that study William O'Neill in Investors Business Daily, this is called a cup and handle.
Well, look at that.
All right, so there's a cup and handle pattern. What that means, just kind of a primer on technical analysis. Technical analysis is nothing more than a visual representation of market psychology. That's what it is. So this is a great way to explain that. So Novo Nordisk, of course, they have a weight loss drug, which actually what didn't start as a weight loss drug, it started as a diabetes drug. And they accidentally found out that people were losing weight. So they kind of
Rebranded.
rebranded it now as a weight loss drug.
There you go.
We'll look at Eli Lilly in a second too, because they're the ones that have the other one. But over here, so it went up, it went up, it went up, it got to here, and then people said, maybe it's too high, I'm going to sell some. So they sold off. But all the people that bought on this day when it gapped up, all these people, when it started going down, they thought, oh my God, did I make a mistake? Maybe I did. Maybe it was too high. So it went down and came back up. And these people here are saying, let me just get out. Let me just break even.
Mm.
So when it got back to where they bought, they sold just to break even. And then other people started seeing it selling. People that bought here said, I don't want to be underwater, so I'm going to sell. So they started selling until it went down here and it reached a point of equilibrium where there were an equal number of sellers and buyers in this area. All right. So it didn't really move one way or the other. It just sort of went sideways. But then it started to trend up slightly, which means there's a few more buyers than sellers. Some more sellers came in right at the end to try to, get out. And then it picked up again. So there's a little support line right there. So more buyers came in and then went back up. And then all these people back over here are like, oh, thank you, God.
I'm out.
I just want to break even. That's all I want to do is I just want to break even. So when it got back to the point back here, they started selling too. So it went down again. But now it didn't go down as much because number one, all the sellers that didn't want to continue to hold are gone.
Yeah, they washed
right?
out. Yeah. Yep.
They're all washed out. What that leaves is the people that want to buy. So they were waiting for another opportunity. So they started to buy here and then it went back up. And now we're at a decision point. Now we're at a point where did all of these people here actually sell? Did the ones that bought here when it went down a little bit? It didn't go down that much. And that's really what defines the handle part of this. You don't want that handle to come down too much. You want it to just come down a little bit because there weren't a lot of sellers. But the question is now, will it be left with nothing but buyers, or will the sellers come back in again?
Got it.
And that's the point that we're at.
Yep.
Now, what happens is professional traders or actually retail traders will say, okay, it's coming back up. I'll put my stop down here somewhere so I can get out. But professional traders are saying, okay, this is a resistance. If it does break through, I'm putting my buy stop, not a sell stop.
Yeah, buy stop. Yeah. Yep.
Where I want to get in, I'm going to put it just above this resistance line because if it breaks through that, then that's confirmation that all of these sellers are gone now. They put their buy orders in right there. So when it does go up and takes that out, not only do you have people that want to buy it, you also have people that are waiting to buy it for it to break it. And then it takes off. And all of this is exactly what William O'Neill taught in his book and what Investors Business Daily says. But that's the kind of the structure of it and why it works that way. and why technical analysis in general works is just a visual representation of market psychology. So
Very,
that's
very
the
cool.
thing to watch. I mean, if you wanted to get into Novo Nordisk, and I actually might do this now that I'm looking at this, what I would do, or actually what I will do, is this high right here. That's the final resistance. So that high is at about, let's see, what's
136.
137.
Oh,
Roughly 137. I'd probably put it at 138, just right
okay.
above that.
All right.
I would do just like what the professional traders are doing. I would put a buy stop order in at 138, and I would put my stop in just below this resistance line at like 134. So the risk is much lower, because if it doesn't work, if all of this is wrong and there aren't a bunch of buyers up here and it starts to come back down again, then you just get out at a very small loss.
Yeah. Okay.
But if it does work, then you're in and
For
you
the
ride
run.
it. Right.
Yeah. Very cool.
I actually will probably do that myself.
Okay, very cool. Well, we talked about Nvidia earlier. I think video number 1. Why don't we ask you to take a look at AMD?
Oh, yeah. AMD. So you would think that because Nvidia had such great earnings, you would think that AMD, which is basically in the same space and basically a competitor, if you will, you would think that they would be going up as well. But actually, let me do it this way. Let me do this. Let me show you both side by side. So we'll do Nvidia on the left and AMD on the right. Okay, so this is the intraday. So here's Nvidia's earnings right there, right on this May 23rd line. Here's the May 23rd line. So Nvidia gapped up. Look what AMD did. It started off higher. It opened higher, but it sold off all day. And as Nvidia continued higher, AMD continued lower. So what is this telling you? To me, it means that Nvidia is so strong that its competitors just won't be able to keep up. And AMD actually might suffer as a result of that. Now, this is a daily view, so you can see daily, there's the gap up for Nvidia for earnings. But if you look at this, you just look at the colors, if nothing else, and you can see AMD after hitting this all-time high over here at 225, it's just been selling off since then. Looked like it was trying to make a comeback right there, but then after the Nvidia earnings, it continued lower.
Yeah.
And then the weekly view, same kind of thing. So this is a weekly, much longer term. This is a 4-year chart. So Nvidia just continually chugging higher, and AMD kind of following along in its footsteps. But now AMD actually looks much worse than Nvidia. So initially you would think that, oh, Nvidia did so well, let me jump onto AMD because AMD is only 100 and, what is the price? $150 stock. Yeah, 155, 160, somewhere in there. And AMD is a lot cheaper, so let me just jump on the coattails of Nvidia and buy that. But Nvidia is just a much stronger company, and Nvidia has such a huge moat around it. It will take 10 years for its competitors to get anywhere close to what Nvidia does. It's not just a chip maker; it is a whole infrastructure.
Chassis.
It's an ecosystem. They have developers developing for their chip. They have hardware makers making hardware specifically for their chip. They have industries that are specifically using their chip, not just AI, but crypto, Bitcoin. We talked about Bitcoin before and how much compute power it takes to make the next block to get your reward of Bitcoin, how much computing power it requires. Well, Nvidia is perfectly aligned for that. And then on top of that is the data centers that are sprouting up all across the country. Nvidia running those data centers. So they have such a huge moat that it'll take 10 years for any competitor to catch up with them. And by that time, Nvidia will have invented something new.
Yeah. Well, Dan, we've got three more strategy questions. We
Sure.
got 10 minutes left. So let's see if we can get to each one of these in 3 minutes.
Okay.
So the first one is, how do you incorporate earnings reports and other company specific events into your trading strategy?
That's a really good question. So Costco has earnings coming up, right?
Mm-hmm. Yeah.
So the first thing I would do, number one, I rarely ever take a new position coming into earnings. Earnings is a binary event. And if I was an options trader, I would have to be very careful about trading options because there's a time expiration on options. Earnings are a binary event. You don't know what's going to happen. They could have blowout earnings and the stock could drop. They could miss earnings and the stock takes off for various reasons. Anything can happen. So one of the things that I do, if there's a stock that I want, if I do decide I want to get into it, like Costco is a very strong company, right? So they have earnings coming up. So is this something that I want to get into? Well, first of all, many strong companies like this will have the run up before earnings. And that's what happened to Costco. And this happens with Nvidia as well. So if we were coming up on earnings and I knew earnings were 30 days away, I'd probably be getting in 30 days before the earnings on a strong company. So I'd be getting in over here on Costco. In fact, I'd be getting in when the 5-day moving average crosses the 21-day moving average. The pink line crosses the blue line right there. That's when I would be getting into Costco. And then I would ride it up and decide what to do after earnings. But the other thing that I look at is this down here, which is a relative chart. We've talked about relative charts before in comparing Target to Walmart, right? But this here compares Costco to all of its peers. How is Costco doing versus all of the peers in its own industry group? Now, usually, in fact, almost all the time, companies about 3 weeks before earnings have a quiet period. They can't talk to analysts. Mm-hmm. Before that 3 weeks, they can talk to analysts. And that's one of the reasons that strong companies that the price starts to move up before earnings, because back in this period here, analysts are talking to the company and they know that the quiet period is coming up, so they won't be able to get any more data. So they gather all the data here, and if it looks good, they start buying. Same thing down here. How are they doing versus their peers? Usually, if they're going to come out with good earnings, they start to accelerate the comparison with their peers in this period as well. So I want to see that too. I don't want to see something like this that's going down. I think AVG or Broadcom, does that report next week? No, that's June 12th. But look at this. So Broadcom is actually underperforming its peers right now. Now we're not yet close to earnings. Well, we're kind of close. Yeah, June 12th is about 3 weeks. That's about 3 weeks away. So this would concern me about Broadcom. So I probably would not buy into Broadcom before their earnings on the 12th because they are underperforming their peers. And this tells me that they actually might miss earnings.
Very cool. All right. Let me go 2 more to go through that I found. Let me make sure I can find them in the chat. Dan, I heard you mention that in 2029, so this is your whole bull bear thing, we can expect a negative decline in the market. What do you do with our stocks if something like this happens? Do we just hold through the storm? Do we sell and go to cash? Do we look at other asset classes?
I have no idea what you should do.
Yeah.
I can't tell you. I don't know. I don't know what each person's risk profile is. I don't know what their overall goals are. I don't know if they're a long-term investor versus a trader. I don't know. But I can tell you based on history, and this concept right here that I'm showing you, this is on the homepage, so you don't need a subscription on my website. And this is so important that I put it out there for anybody to look at anytime they want. I update it every week. This is a monthly chart. So this is the secular bull versus secular bear charts, and that's what they were referring to, the 2029 period. Yep. So secular bulls typically last about 18 to 20 years. Secular bears last about 12 years. This has been true going back 100 years. So the last secular bear market we had after the dot-com bust, the market went down. There was a little cyclical bull, so the market went up, but it never broke above the previous high. And then we had the financial crisis, the housing crisis. Market went back down again and came back up. and didn't actually break out until 2013. So that's a 12-year period when the market essentially just went sideways. Now, if you're a trader, you could have traded these cyclical periods, the shorter term bull market. That's why I say I can't tell you what to do, because I don't know what kind of person, what kind of trader you are.
Right.
But the current secular bull started in 2013, or you could count it from the low in 2009. But somewhere in the 2029 to 2033 period, the secular bull will probably end. We'll start a new secular bear. It probably will be a nasty one, and the market will start to come down again. Now, having said that, that does not mean we can't have a cyclical bear market before that. All right. So here's COVID, barely a blip. It never closed below the 200-week moving average. That's one of the criteria. So each of these three is green. So what I'll be looking for is for one of these to turn red, like they did over here. As soon as one of these turns red, then that's the warning sign that we might be heading into another secular bear market. But they're a long way away from that right now. But it could come down. So here's the 2022 bear market. So we hit the peak right here, and we came back down right to that 200-day. That was a full year, almost a year bear market. That was a cyclical bear. This is COVID. It never broke the secular bull. This is 2018, the trade war. Here's 2016 period. Never broke that line right there. So in fact, back here in the previous secular bull, can you pick out the 1987 market crash?
Wow. No.
Can you find it?
It's not on the screen. It only goes back to 1990.
1987. It's right here.
If I'm reading that chart right, that's 1997.
Actually, that's 98. Yeah, you're right. 87 is right.
It's not on the screen.
It doesn't go to 87. Yeah, sorry, it doesn't go to 87. But even so, it's kind of like the COVID crash right here.
Just a blip.
It's barely a blip. So it does not affect it. When these things happen, and when this one in 2022 happened, I said then, yes, we're in a bear market, but it's not going to last. We are going back to new highs. And I said that all through 22, and I was on this channel saying it. I said it in the beginning of 23, we're going to be back at all-time highs.
Very cool.
It took us a little bit longer. It took us till January.
Yeah, it was still a great call. I mean, that was a very good call. So here's
we're in a secular bull. Now, what do you do? What do you do when this turns into a secular bear and it becomes really ugly? Like that will be a major crash when it happens. And I think it will be related to the debt, the US debt and bonds. Well, what you do is between now and then, you learn how to short. Learn how to short things and take your profits before this happens. Just move out and go to cash.
All right. Well, speaking of that, we got a question about Nvidia and Amazon, but it's really more of a general question. Regarding Nvidia and Amazon, if you have a handsome profit over the past 2 years plus, do you still hold? Basically, you got big winners. What do you do?
Well, clearly you hold Nvidia. Clearly. You're going to get a split and you're going to have more shares. So why not hold it? Amazon, probably the same thing. I don't think Amazon's not going anywhere. This is on my website. These are the Magnificent Seven down here with all their charts. This right here will show you a short-term, mid-term, and long-term trend. So Amazon right here just gave a short-term bear trend. So it looks like it's in a short-term downtrend. Medium-term and long-term is still bullish. If we look at the chart, there it is. There's the short-term trend right there. So if you look at a long-term over 2 years, Amazon has had a great run. So Amazon, I don't think is going to probably decline much more until the rest of the market does. It will go along with the market.
Well, let's talk about in general.
Right now, I wouldn't sell it. Right now, it still looks great.
Yeah. Well, let's take, instead of those two behemoths, why don't we just talk about generally speaking? You get into a stock, you're in a stock for 3 years. It does what you think it's going to do. It goes up, I don't know, 200%. Generally speaking, when do you know to sell, take some profits? Do you have a general strategy?
Well, I use the charts, clearly. So one of the things that I will do, this is a daily chart right here. So you can see the lines that I've drawn with with Amazon on a shorter term basis. If I look at these are momentum indicators right here. Down here is a long-term MACD moving average. I'm not going to get into what makes these up, but these are the ones that I use after 20 years of experimenting with different indicators. So these crossed to the negative side right here and right here, even though the price had not crossed yet. But this is when I would start to begin to think about getting out, and probably and also this one up here just crossed over. So as soon as this crossed the 21-day moving average, I'd probably be out right there.
Right.
And I would stay out until this vertical green line when everything crossed back to the upside. So in this case, I would have been out for about a month and a half. If I wanted to be a much longer term investor, then I would use longer term charts, like which are weekly charts, basically. Like on my portfolios page is a market timing strategy that I track. The last time the signals fired in 1 year, it doubled its money. Right now, we're in it since May 6th, up about 7.5% or so. But these have long-term charts, and down at the bottom is actually the total market index. So if you just want to look at every single thing in the market, it's basically made up of all these things: the Dow, the NASDAQ, the S&P, the Russell, and 3,800 other stocks is in the VTI. And we can look at a weekly chart like this. And now what I would do is I would just use the 40 and the 50-day moving averages. And I would get out when they cross. So that's this red arrow right here. I would wait until they turn green again. And I would get back in on the first green bar, which is right here. So in this case, I would have been out for a little over a year, almost a year and 2 months, just sitting in cash, or you could go to an inverse ETF and actually make money. That's what I mean by learn how to short. When the market crashes in 29, go into inverse ETFs and actually make money when it's crashing. But I would be in cash through this period, and when it turns back again, I would be back in the market and wouldn't be out. It's still green. So this is a long term from 2023, more than a year. You would be long. You'd have to live through this market decline right here, and this one that we had in April. But that's what I would do as a long-term investor, just to stick with something. And you can do this for anything you want. I could do it for Costco. Costco is in a long-term uptrend. It gave a long-term sell signal right here, and it just went sideways until over here, and then it started going back up again.
Very cool.
AVGO, that's in a long-term uptrend. Nvidia, I expect to look the same. So Nvidia right here is beginning of 23 is when you would get in Nvidia, around $230 roughly, and never sell it.
Yeah, very cool.
Until those cross. So that's a 40-day exponential moving average and a 50. Actually, these are weekly charts. So remember I said long term. So this is a 40-week exponential moving average and a 50-week simple moving average.
There you go. Well, Dan, you're amazing. Thank you for doing this each week with us, especially with the school community, taking questions from the audience. One more time, show your website.
Breakpointtrading.net. Free newsletter is right there. There's a bunch of things on the homepage that you can look at. This is the current secular bull market that we are currently in. Started in 2009, officially in 2013, and we are still in the upper half of this. So we haven't broken that. We're getting near the top, by the way. So that's why I'm saying in 2025, I'm expecting this to come back down to the midpoint in 25. But we're not quite there yet. We've still got some upside left for this year.
Very cool. Well, Dan, you're amazing. Thank you, everybody, for being a part of this. Until next time.
Later. Yeah, this was fun.
Thank you, buddy. Bye.
Take care.